a systematic way to pick high performing stocks, those that are delivering very strong returns with solid momentum while also managing the risk. In this video, we will see step-by-step process to create a list of momentum stocks based on return, risk, that is volatility, and also trend indicators. So the goal is to build a portfolio focused on top performing stocks. But remember, no strategy is without risk. So watch till the very end to understand the potential downside and the risks of momentum investing. So the first step is to identify the universe from where we will be picking the stocks. For example, it could be Nifty 50 if you want to focus on stable, high liquids names and relatively lower risk compared to say a Nifty 200 or Nifty 500, which comprises mid-cap and small-cap stocks and also large-cap. So the first step is how much risk do you want to take. In this example, we are considering the Nifty 200 universe as an example, and you want to pick high momentum stocks from this. You can first go to NSE India website and download a list of stocks that represent Nifty 200. So it will show all the Nifty 200 stocks in this index. In this Excel sheet, you will now see returns in the last column. This is the past 1 year return of each stock. You can arrange them in the order of highest return to lowest. Now comes the most important step 2. It is to normalize this data. You have to normalize because some of the stocks could have split or gone for a bonus. So you will have to make those adjustments into this sheet before proceeding further. So you will see, for example, some stocks with nil returns. First, these things have to be fixed. So there are many sites which will offer this cleaned up data, and I'll provide a few in the descriptions. For example, when you go down, you will see that Nestle is showing incorrect returns of minus 90% for the past 1 year. If you actually check the return, it's about minus 6%. So you'll have to check in TradingView or any other site, and you will see that there was a split of 10:1 for this particular stock. You can use this site or charting to get these data. But here, the idea is to explain the steps so that you are independent of any tool. And once you get the process idea, you could follow any other site. So let us assume you have normalized this data and you have very clean data which are ranked based on returns. So now comes the interesting part. You have ranked the stocks based on returns. This is 1 year return. You can also improvise this to look at a 6-month return and give 50% weight to each of that. That way, you're not just looking at short-term spikes, but you're also factoring slightly long-term consistent performance over a year also. Then you arrange the stocks in order of their weighted returns, with the highest return stock at the top. For this illustration, as an example, if you think this is the list that is normalized and clean data is arranged in order of return, then the first 30 stocks become your portfolio. Let me caution, this is a very simplified way of looking at it and is just the step 1 of building a momentum portfolio. So just ranking the stocks by return is very risky because along with high return comes high volatility or high risk. So to account for risk, we will add a volatility filter and calculate risk-adjusted return. For that, you need to download daily stock prices for the past 1 year, and then you calculate the daily return, which is the percentage change from one day to the next day. Then you will find standard deviation of these daily returns using an Excel formula. Now, momentum portfolios tend to perform very well in a trending market. So the biggest risk is that during a downturn, these portfolios crash as fast as they have gone up, or even worse. One way to manage this risk is by looking at 200-day moving average price. This is how it works. If the Nifty 200 index or whichever benchmark you're using is trading above its own 200-day moving average, you can consider this as a bullish signal. And this is when momentum strategies normally works best. So if you want to refine it even further, you can check if each of the stocks in the 30 list is also trading above that 200-day moving average. If the stock is trending above 200 DMA, you take it. Otherwise, you skip and move to the next stock. This makes sure that we are invested in stocks that are always trending upwards. Now, to refine this list even further, we can use an RSI indicator, which is Relative Strength Index. If the stock's RSI is above 60, it indicates a very strong momentum. This helps us filter stocks that are not on an uptrend or are showing significant weakness or not showing enough buying strength. From here, you can narrow down to a final list of 30 or 20 or 50 stocks, how many ever you may prefer to have in your portfolio. So let's summarize this with a simple example. You have identified the Nifty 200 as your universe. You have normalized and cleaned the data for splits and bonuses. You have added the stocks by their 6-month and 1-year returns, and you have filtered out volatility. After that, you have checked each stock's 200-day moving average and RSI to ensure that they are in a strong upward trend. Through this process, you have identified, let's say, 30 high momentum stocks that are not just top performing stocks, but are also showing very positive trends in the current market scenario. Now you've got a portfolio of potential winners, stocks with very strong returns, relatively manageable risk, and momentum is confirmed by the technical indicators that we have used. You can use the help of such tools such as charting to prepare this, and then you repeat this process on a regular basis. It could be weekly, monthly, or quarterly. So when you rebalance, you will find that new stocks are moving in, and they will replace some previous stocks that have lost out on the momentum and are now coming down on the price. When market crashes, some of these technical indicators will show you that there are not many stocks that adhere to these filters and will automatically help you move into a cash position. Remember, momentum investing works in a trending market. So always keep an eye for broader market trends, especially if you're using technical indicators like 200 DMA or RSI. Now, if you're a very conservative investor and want to take even a lower risk, you can add more volatility filters or focus on relative stable Nifty 50 universe. So no strategy is foolproof. So always be prepared to review and adjust to market conditions. The biggest flip side of momentum investing is that it is very different from growth or value investing, where you buy stocks that are relatively cheap. In momentum style of investing, this is 180-degree opposite to this. You buy stocks that are going up in price every day. It's getting more and more expensive. So psychologically, it is very difficult for a value investor to adopt this approach. The other aspect is that there will be a number of stocks that actually lose, which are on the losing side. They go down in price, so one has to be willing to sell them and cut your loss, which is again psychologically very difficult. It's easy to sell a winner, but not a loser. But in momentum investing, you need to ride the winner. So as the prices go up, you need to overcome fear and hold on. At the same time, when the prices go down, you should be willing to cut your losses. This is the key to this style of investing. So in your portfolio, there will be very few stocks that are going up and relatively a larger number of stocks that are coming down. So the idea of this video is to educate about why behind each step rather than show how. So it's not about giving a list of stocks, but learning the logic behind it, which might add value and knowledge to your investing journey. In fact, if this strategy interests you and you want to invest without doing all this work, then you have a ready-made index fund that does this. Do read and research from here. If you need a copy of this detailed report, you can email me here. Do remember, momentum investing is high risk. It goes through its own cycles of underperformance and also huge corrections in a crashing market. So whether or not momentum investing should be core to your portfolio is something that you'll have to decide in consultation with your financial advisor. This video is purely educational and not a recommendation. I hope you like the content of this video. If so, please like this video, subscribe to this channel and share it with your friends.